Welcome, Steve. Steve Doidge from RealCap. And welcome to our conversation. Steve and I are going to be looking into fear and greed and how that impacts how we show up in the market, in a volatile market. And I was just saying earlier to Steve that for me, fear and greed from a coaching perspective, I know people are going into their insecure thinking. And when we go into insecure thinking, we're often very reactive rather than just taking a step back and letting our mind settle so that we can get some clear thinking and perspective. And I know, Steve, you've also got some ideas on how that, from your practical experience in the market and having been around for a while and made lots of money and lost lots of money, how it works in practical terms. So you also look at how the volatility in the market is just, we really do have this feeling of being out of control. And
yeah, absolutely. So, I mean, what's quite scary as well to think that the last time there was a serious market correction was back in the 2007-2008 crisis. So, I mean, I think when we chatted the other day, I think Brian made a comment that, most money managers today haven't really actually seen a proper market crash. Not only are investors, when it does come, which it always does, and things go in cycles, a lot of investors are going to have to deal with the fear element, but I think the managers are going to have to deal with it as well. And just on the fear side of the equation, what we often see is this lack of control. Investors just absolutely panicking, needing to take control of a situation, which, let's be honest, is totally out of one's control. And the only one thing that one can do to get a bit of sort of control over the situation is to panic sell. And when this happens across the globe, when you're looking at a global market where you've got, panic selling across the board, that becomes a self-fulfilling prophecy in its own right. And that mass selling causes further downward pressure, further panic, and you get this sort of self-destructive cycle going on. So definitely, coming back to your comment about, sort of insecurities, etc., and linking that into control, it's definitely, from a client perspective, they definitely need to mentally be able to cope with these situations far better than what they are at the moment.
And how do you do that, Steve? I mean, what do you do when it kind of, the proverbial hits the fan?
Can't say it's pleasant. We've been through quite a few market corrections in our time. So I must be honest with you. To me, it's about, there's different trading. So, from a trader's perspective, this volatility is absolutely welcome. So every time there is a big market correction, a lot of money can be made trading. What we do though is more investing for the long term. And I guess it's just sticking to your strategy. Knowing that if one looks over the last 60 years in the market, these corrections take place, these crashes take place, but they do always, the market always comes back. I was looking at some figures before our chat, and inevitably what happens in a market crisis is that people sell, market hits rock bottom, generally has a massive wild swing on the upside. Investors then get back in after the market's already corrected 10, 15, 20%. And this timing creates such sort of an impact on the return. So just looking for the last 20 years on the American market, on the S&P, you would have got about 8% in dollars per annum if you just stuck out all the ups and downs, which is in dollar terms a really good return. If you miss the best 5 days in the market, and all those best 5 days are always after a significant correction. So typical clients panic sell, the market goes up a bit and they get back in. But just by missing those days where the market does correct after during that volatility, the return goes from 8% to 5%, which is significant. So 3% per annum difference. If you miss the best 10 days in a correction phase of the market, where the market's volatile, swinging up and down, your return goes down to 3%. So just from a timing perspective, you can see how devastating it is when investors panic at the bottom or panic in the downward side of a correction and then get in much later. And the bottom line is, if you've been out the market for 20 days, the best 20 days, your return basically would be zero for the last 20 years. And that's quite frightening. I mean, 20 days not being exposed in the market, panic selling and not being exposed. In the American market, we'd have got basically 0.5% per annum, as opposed to sticking it out and getting 8% per annum for the last 20. So it's this panic selling on the fear side, which is really, really devastating. So from our perspective, we keep a cool head. Obviously, got to educate clients. Hopefully portfolios do take into account these corrections prior to when they happen. But it's never ever a good idea not to have exposure, for instance, to equities, which is the most risky asset class. You can never ever time the market, and one should never ever be completely out the market for the reasons I've spoken about now.
Yeah, and also the thing is, people often waiting on the greed side. It's kind of, okay, I need to sell at the top. So often you just hang in there, even though there might be indicators that saying it's time to sell.
Absolutely. I mean, greed is the other driving force in the market. And, we also, we know very well that when returns aren't returns until they're actually taken. So when you've got a statement every quarter, or an investor logs onto their account and sees they're up 50, 60, 70%, whatever it is, those returns aren't booked until they are physically, profit is taken. So on the more speculative positions, you've got to absolutely, clients need to be aware that greed is a driving force, and to be disciplined and set specific return hurdle rates for the more speculative investments and take profits, because paper profits aren't anything until they're totally booked. And just like fear, where you have this sort of self-fulfilling prophecy on the downside, where panic selling starts and it spreads and it creates a downward momentum, on the greed side as well. I mean, the more market carries on defying all sorts of economic odds, the more people want to invest. So one of the biggest indicators we look at to see when a market's in a fear or a greed phase are the few things we look at. And one of them is just retail flows into equity trust funds globally. So the more individuals are putting money into equities, the more that this momentum starts building. That's a very good sign that you are in a greed greed period in the market, and it's one of the big things we look at, flows into the market from retail investors, because they generally are greedy and chase returns when they shouldn't be, when they should have a little bit more risk averse and be taking more of their fear emotion into account. So that's definitely something we look at.
Yeah, so I mean, what's interesting, what you point at, is that it's all about staying in the game with less focus on the results, less focus on the scorecard. Because you're saying, if we just stay in the game, if we're in there in the first 5 days, if we just look at the market indicators and don't get caught up in the greed cycle, you're actually in the game. You're not out the game. The longer you're out the game, or the longer you haven't got it focused on what the game's doing, actually playing the game, that's when you are more at risk, and that's when you have the uncontrollable comes more to the fore. The market's always going to be uncontrollable to some extent, but your capacity to respond to it is kind of where and it's not control, but it's like you don't get caught up in the uncontrollable. You come to it and you meet the uncontrollable in a clear way, with confidence, in a way.
Yeah, absolutely. And I think a lot of that is almost before you invest, to set clear goals for yourself and to tell yourself, the strategy, look at the risk involved in a particular strategy, and come to terms with the fact that during a particular year, 2-3 years, it might be periods where you might sustain losses in equity market in excess of 25-30% per annum. And then also to know that these things do happen, and it comes part and parcel of investing. So I think it is about educating yourself and educating, from our perspective, educating clients, so that when these corrections do happen, that they are disciplined enough to not panic. And what you alluded to earlier as well, being in the game, is so important. I mean, technically, global markets have been oversold overbought, so too expensive for the last 3 years. So if you look at fundamental economic factors the last 3 years, the markets have not been cheap by any margin. And a lot of clients have been sitting on the sidelines waiting for this correction to happen. But if you look at what the markets have done, especially the tech sector over the last 3 years, I mean, the returns have been absolutely phenomenal. Looking at tech returns over the last 3 years, some of the big tech names, Facebook's, Alphabet's, Google, Amazon, I mean, looking at returns of sort of between 80 and 100% in dollar terms. Had 3 years ago, you said, I'm not going to be in this game. I'm going to sit on the sideline and wait. I mean, you would have lost out significantly. And then emotionally, what we see starting to happen is this greed kicking in. The clients see, its shares are going up and up and up and up. I've watched it go up 80%. I better get in now. And exactly when they shouldn't be getting, that's when they actually do get it. So it's very, very difficult to manage.
Yeah, it's interesting though, from when I look at the parallel in your game and I look at it from my coaching perspective, because it's exactly about being in the game and not, I mean, if you look at the Springbok scorecard over the last couple of years, we've won some games and we've lost some games, you know, and I guess that the market and anything is going to be like that. But what happens is the more clarity, the more we can settle down and realize that's the nature of the market. How do I respond in that space? And knowing the fundamentals, I have less thinking of it and I go less into the panic cycle. I have a clearer head, I can make better decisions, and I don't get so caught up in the emotion of it. But the thing is, we're dealing with money, so people do feel like and we forget that money's a result, and it doesn't necessarily define us. What defines us is our capacity to stay in the game, to create more, to stay in that creative process, and not get hooked into the fear and greed, the loss, the result of it. And I always find that really interesting, because it's just like a metaphor really for life itself.
No, absolutely. And the reality is, no matter what the market is doing, there are always opportunities. You might have to look a little bit harder at certain periods of time, but there's always opportunities. And a lot of people have been sitting on the sidelines, and they've lost out a tremendous amount. Your analogy to the Springboks is quite interesting, in that I think if you look at the Springboks results and previous coaches, the knee-jerk reaction to a bad result is to change, key positions, bring in new players and try something new, where the analogy perhaps should be stick with your core, invest in them, back them, and they're going to go through periods of time where they lose quite a bit, but we see panic restructuring in the Springboks almost as much as we see panic restructuring of portfolios. Some managers overseas, interestingly enough, their mandates include a provision that clients actually instruct them not to sell during certain periods which are classified as correction. So let's say the market is crashing 5-6%. The mandates are preset up, so the client, to prevent him from panicking, they specifically are not allowed to sell. They almost tell the manager up front, look, if there's a correction and I tell you to sell, you can't actually sell. And that's quite an interesting sort of trying to pre-program clients' mentality during a panic phase. It's quite an interesting concept. I think it'd be quite difficult if one of our clients started screaming and shouting, saying sell, and I said to them, well, you agree that we shouldn't. It'd be quite interesting for us to try out. Inevitably, the clients always settle down and things come right.
Yeah, and our thinking tends to settle down. I think any one of us, if we've heard bad news or good news, it doesn't last. It doesn't stay at the same intensity. As over time, that thinking does settle down, and something new, and you start spotting other opportunities, or you get on with whatever life presents in the moment. And that's true too for what you're describing.
Yeah, absolutely. I mean, absolutely.
Yeah.
And in panic markets, what you find is any bit of bad news is absolutely blown out of all proportion. And it's almost used to sort of make investors feel comfortable emotionally about the fact that they've sold. So they sell in a panic, and then there's a little bit of bad news and the market completely overreacts, and investors think, oh, well, thank goodness we're not in the market. On the greed side of things, you get the opposite, where you get the most trivial bit of news coming out and the market reacts by jumping 2-3%. I think Tesla, for me, has been a very interesting company to sort of look at from a fear and greed perspective. It's the most shorted stock globally in the market. Shorted means it's got the most investors betting that the price will actually drop significantly, and it's got the most significant long, on the upside. It's had massive performance on the upside as well. And Tesla at the moment, you've got that product of South Africa, Elon Musk, who's literally got this really persona about him. All he has to do to up his stock 5-6% is go online during an AGM. Come with, just say some sort of, not ridiculous, but sort of quite outlandish statements about how he's going to, he's going to meet production on the new Tesla, or short sellers are going to be crushed in 5 days' time. And literally, with absolute literally what he says, he can move his share price up significantly. And to me, that's a clear indication in that particular stock of sort of greed definitely coming to play.
Yeah. No, it is interesting how, and I think it also points to something else that I know we've spoken about before, is how we have this tendency to be greedy and to kind of go with the next flavor of the month and whatever that might be, and to overreact, putting too much into that space. And then when things fall, you always get these stories of somebody's lost everything. And I mean, that's also something, and that also speaks to greed, is that we lose reason. We lose our common sense in a market where potentially we're dealing with money, and we get so caught into the focus of money, we forget the fundamentals of what we're doing.
Absolutely. I mean, there's a famous saying in the market that you should be fearful when others are greedy, and greedy when others are fearful. I think that's one of the most important things. Unfortunately, as I said, even if a market is very expensive, it can carry on being expensive for years and years and years. And if you're not in that market, you're going to lose out. So yeah, it's all very, very difficult to manage. There's a lot of emotion involved. And yeah, it's just at the end of the day, everything that you've been saying makes absolute sense. I think investors should be much more aware of the mental, emotional side when investing. And I think that can positively impact their results by a magnificent sort of amount.
Well, our emotions are always linked to our thinking. So you can't have an emotion without having some thought going on in the process. So if we're going to believe our thinking all the time, or we're going to use emotions as an indicator of when to react or when to do something, it's not really useful until our thinking's settled and we get some clarity. And so, when you're in emotion, it's not the time to act.
Absolutely. And unfortunately, the sophistication of our market is, we've got these weapons of mass destruction on the greed side. Leverage. So, globally, interest rates are ridiculously low. All the stockbrokers, all the banks will give you, for every dollar you've got in the market, they'll give you another 2 to invest. Derivatives give you sort of massively leveraged exposures. You can get finance, as I said. So, if you're greedy, there's enough financial institutions globally that are going to feed that greed and help you be not just greedy, but almost gluttonous to a massive extent. And literally these things, in a normal situation, you might lose 30-40% in a down cycle, but with these weapons of mass destruction, which are available to clients to absolutely wipe themselves out, as you said, you literally can't lose everything very quickly. And the other problem with the market is that it's so sophisticated that the liquidity, I mean, you can literally sell, $10 million worth of a particular share, literally at the click of a button. So unlike, for instance, for fixed property, where, let's say there's a bit of a correction, you can't just sell it straight away. You've got time to think, to reflect. With the market, you literally can log on, push a button, and you're out, completely out. And that together with these, we like to call them weapons of mass destruction, where clients can get just such overexposure to anything. I mean, that can seriously take you out. Mm-hmm. And clients start forgetting about basic principles when greed takes diversification. So I mentioned Facebook, Amazon, Alphabet, etc. They're going up at a rapid pace over the last couple of years. So instead of having a diversified portfolio, they'll go and throw everything in there, or they'll put everything in Tesla, hoping to double their money. And of course, when the markets do correct, that's when you stand to lose the most, when you're overexposed to a particular stock. Having said that, investors in the market that have made the most money, and managers, it's not about just diversifying for the sake of diversifying. You do have to take on that risk. So it is about identifying which companies and which sectors are going to be winners and backing them more than a sort of a market neutral exposure would allow. So as much as greed does take hold and people become obsessed with certain sectors, as managers, also our job to identify those sectors which we believe are going to outperform and have conviction to allocate outsized amounts of capital to them.
So what would your advice be to guys who've only been in the market in the last, 10 years? So they haven't actually experienced one of these drops in the market or a crisis as such, a correction, and they've got to manage themselves, but also their clients. And even for clients who've only been recently in the market, and have only ever experienced this wonderful upturn.
You know what, it sounds a little bit perhaps cruel, but the best lesson that you learn is by actually using money. When we interview managers to come and work for us, the first question I ask them is, don't tell me about all the winners that you've picked in your career. Tell me about the losses and how you handled that. But for youngsters starting out, as I said, it's so easy to get exposure to anything. You can get leverage, you can get finance. I guess the reality is, the advice is, the older I get, it's like, I remember your parents would tell you, don't do this, don't do that, and you just ignore them. I feel a bit of the same way when I talk to the younger guys saying, listen, markets do correct. And you start feeling a bit old. You start feeling a bit antiquated. Like, oh, rubbish. In a new paradigm now. It's not about earnings. It's about growth. It's about technology. It's about the amount of times I hear the word disruptive technology is increasing on a daily basis. And sure, those things are exciting, but at the end of the day, the markets do correct, and when they do, it's not always pleasant. But having said that, panic is the worst enemy in a downward correcting market.
I must say it is going to be interesting because there is a whole lot of new dynamic coming into the market in terms of technology and disruptive, and you've got the blockchain technology, and so it is going to be interesting how things do pan out, and if there is a new footing that comes, if there is a new dynamic that comes into play. But as you say, you just got to be level-headed about it.
I think the biggest challenge is, and in my own career, I've seen this lots of time, but we've got a really good investment idea, but it's to try and implement that idea practically. And usually on the listed market, so the listed equity market, by the time a disruptive technology is in that space, it's perhaps a little bit too late to have the maximum benefit from it. One really needs to invest in venture capital type situations, in startups. And in South Africa, I mean, that is a very limited market. Overseas, it's obviously a lot bigger in terms of investment opportunity, but for South Africans in particular, very difficult to get exposure to. So there's this sort of delinking of a good investment idea, disruptive technology, but actually accessing something that will give you exposure to it. And by the time there's an easy to buy instrument for the retail investor linked to a so-called disruptive technology, it's potentially way too late.
Yeah, and that's so it's going to be an interesting space. So thanks, Steve, very much. And for everybody who's looking to the future, investing, watch out for fear and greed. And
thanks, Bev.
It's go with experience, I think. At the end of the day, it's a bit of both, a bit of experience and a bit of flair. It's about, rugby team's got all of them. You've got all the different positions, all the different players. And at the end of the day, you've got to have the whole lot in the team to
absolutely
your investment to keep going, and to make a difference in your portfolio.
Absolutely. And on the more speculative side of things, you have to take risk. And a good investment manager isn't someone that doesn't take risk. You do need to take risk, but you need to manage it accordingly.
So thanks very much, Steve.
Thanks, Bev.
And if anybody needs to find Steve, you can find him at RealFin Cap, Steve, and we'll put your details at the bottom so that they can grab you if they're interested. Awesome.
Cool. Thanks, Bev.